all things finance. In my last 3 videos, I have talked about bonds, bond markets, and bond valuation, which are essentially firms' debt securities issued to the public. This time, I will be talking about stocks and stock markets. In this video, you are expected to learn the following: private equity, public equity, stock market and exchanges, difference between primary and secondary markets. You will also learn the terms underwriter, syndicate, IPO, preemptive right. So private equity. Essentially, when a firm is created, its founders typically invest their own money in the business. The founders may also invite family and friends to invest equity in the business. These funds are referred to as private equity because the business is privately held and the owners cannot sell their shares to the public. A share, or a shares of stock, or just stock, represents the equity ownership of a corporation divided up into units so that multiple people can own a percentage of a business. This entitles the owner of the stock to a proportion of the corporation's assets and profits equal to how much stock they own. Ownership is determined by the number of shares a person owns relative to the number of outstanding shares. For example, if a company has 1,000 shares of stock outstanding and one person owns 100 shares, that person would own and have claim to 10% of the company's assets and earnings. Corporation Z is currently selling Product X. Over time, Product X gained popularity and has increasing demands. Corporation Z can no longer meet the demands on its current state and decided to expand their operations. In order for them to finance this expansion, the owners of Corporation Z decided to issue more shares to their close friends and family. Corporation Z also has other options known as private equity financing. Some of the more common private equity financing are venture capital or VC funds, private equity funds, and crowdfunding. Venture capital or VC funds are pooled investment funds that manage the money of investors who seek private equity stakes in startups and small medium-sized enterprises with strong growth potential. A VC fund receives money from wealthy investors and from pension funds that are willing to maintain the investment for a long-term period such as 5 to 10 years. These investors are not allowed to withdraw their money before a specified deadline. A VC fund uses the money that it receives from its investors to purchase minority stakes in selected private companies that need funding. Next is private equity fund. It is an alternative investment class and consists of capital that is not listed on a public exchange. Like venture capital, private equity is composed of funds and investors like pension funds and insurance companies that directly invest in private companies. In addition to VC and private equity funds, new companies today have the option of trying to raise funds from a larger number of investors through a process of crowdfunding over the internet. Hundreds of websites now provide crowdfunding platforms of various types. The top sites for 2020 are Kickstarter, Indiegogo, and Crowdfunder. Now let's move on to public equity. Later on, as the increased sales and demands continued, Corporation Z needed more expansion of its operations and ultimately needed more financing. For the first time, the board of directors of Corporation Z decided to go public. When a corporation first decides to issue stock to the public in an effort to raise funds, it engages in an initial public offering or IPO. An IPO is used not only to obtain new funding, but also to offer some founders and VC funds a way to cash out their investment. Because private firms are typically not well known to investors when those firms engage in an IPO, they must provide detailed information about their operations and their financial condition to attract investors. A firm engaged in IPO usually hires a securities firm that serves as the lead underwriter for the IPO. The lead underwriter is involved in the development of the prospectus, the organization of the roadshow, and the pricing and placement of the shares. Before the roadshow, the firm and its underwriters will have begun to consider the price at which the firm's stock will be offered to the public. The firm may rely on the lead underwriter to determine the so-called offer price, which is based on the valuation of the firm. Businesses are commonly assigned a valuation that reflects the present value of the future cash flows. The lead underwriter may forecast future cash flows of an IPO firm based on the firm's recent earnings. However, many firms have experienced negative earnings before going public. Their ability to sell shares at a high price is heavily influenced by the expected growth in their revenue and earnings over time. The growth estimates are based on the company's business model as well as on its employees, management style, creativity, reputation, and competition. Nevertheless, it is difficult to forecast growth in revenues or earnings of a young firm at the time it engages in an IPO. The lead underwriter may rely on a group called syndicate of other securities firms to participate in the underwriting process and share the fees to be received for the underwriting. Each underwriter in the syndicate contacts institutional investors and informs them of the offering. Most of the shares are sold to institutional investors rather than individual investors, and it is more convenient for the underwriting syndicate to sell shares in large blocks. Brokerage firms may receive a very small portion of the IPO shares which they can sell to their individual investors. Perhaps not surprisingly, they usually give priority to their biggest customers. Even after a firm has gone public, it may issue more stock or repurchase some of the stock that it previously issued. A firm may need to raise additional equity to support its growth or to expand its operations. A secondary stock offering is a new stock offering by a specific firm whose stock is already publicly traded. Some firms have engaged in several secondary offerings to support their expansion. Corporations sometimes direct their sales of stock toward a particular group, such as their existing shareholders, by giving them preemptive rights, first priority to purchase new stocks. Primary market. Primary market is where the shares are sold for the first time. IPO is an example of a primary market. Any shares of stock that has been issued or as a result of an IPO or a secondary offering can be traded by investors in the secondary market. Stock trading between investors occurs on the organized stock exchanges and over-the-counter market. An organized exchange is a securities marketplace where buyers and sellers regularly trade securities in the secondary market. Although there are several organized stock exchanges in the United States, the New York Stock Exchange, NYSE, which is owned by the Intercontinental Exchange, and the NASDAQ, National Association of Securities Dealers Association, are by far the largest. In a nutshell, stock markets provide a secure and regulated environment where market participants can transact in shares and other eligible financial instruments with confidence with zero to low operational risk. Operating under the defined rules as stated by the regulator, the stock markets act as primary markets and as secondary markets. Thank you so much for watching. If you love this video, please leave a thumbs up and do not forget to subscribe. Till next time!